Bitcoin's 13% crash explained. The hidden mechanics nobody is talking about. Bitcoin just experienced a statistically rare 3.5 sigma crash. A move so sharp, it's only supposed to happen once every few years. And yet, there was no hack, no exchange collapse, no government ban, no villain. So what actually happened? Today, we're breaking down the 3 hidden mechanics behind this 13% drop and why understanding them changes how you see Bitcoin forever. Let's start with the move itself. A 13% decline in a single session. Statistically extreme, the kind of move that usually requires a crisis. But here's what made this different. Bitcoin ETFs recorded massive trading volume, over $10 billion in a single day. And even more confusing, they showed net inflows, money flowing in. At the same time, price was collapsing. How can price crash while inflows are positive? That contradiction is the key to the entire story, because this wasn't about news, it was about positioning. For years, Bitcoin traded like its own ecosystem. But today, it sits inside institutional portfolios, right next to software stocks, right next to AI companies, right next to other high-growth assets. It's integrated into traditional finance. That means when large funds reduce risk, they don't sell one thing, they sell everything. This is where the first mechanism comes in, degrossing. When volatility spikes, hedge funds reduce exposure across their books. They cut leverage, they shrink positions, they hit the sell button on entire categories. Not because they hate Bitcoin, not because of a headline, but because risk models tell them to. Bitcoin was liquidated alongside equities. It wasn't targeted, it was grouped. And when correlations rise, everything moves together. But that was only the trigger. The accelerant was something called the basis trade. Here's how it works. Institutional traders buy the ETF. At the same time, they short Bitcoin futures. They capture the small difference between the two prices, the spread, maybe 3%. Low risk, market neutral. But only as long as volatility stays contained. When volatility spikes, that spread can explode. 3% becomes 9%. Suddenly, the trade isn't stable anymore. Risk managers step in. They force it closed, which means selling the ETF and covering the futures position. That creates pressure on both sides of the market. And when multiple funds are running the same strategy, unwinding becomes contagious. One fund closes, then another, then another. It turns into a domino effect. This wasn't retail panic, it was structured leverage being mechanically removed from the system. Now we move to the third mechanism, dealer hedging and structured products. Large institutions use options and structured notes tied to Bitcoin ETFs. Dealers who sell those products must hedge their exposure. They don't get to choose. When price hits certain levels, what we call knock-in levels, automatic hedging triggers. If price falls through those levels, dealers must sell shares to stay neutral. And here's the feedback loop. Price falls, dealers hedge to stay neutral. That selling pushes price lower, which forces more hedging, a revolving door of mechanical selling. In some cases, market makers even short ETF shares they don't currently own. Then they create new ETF units to balance the position. That process shows up as inflows. But it's not bullish buying, it's plumbing, it's structural mechanics. And that explains the strange contradiction. Why did ETFs show inflows on a crash day? Because market makers were creating new shares to hedge exposure, not because investors were rushing in with conviction. The plumbing system expanded under stress. Then the next day, as volatility cooled, the system reset. In crypto-native markets, open interest collapsed quickly. In traditional finance structures, it takes a little longer, but the mechanism is the same. Leverage expands, then leverage contracts. Now zoom out. Bitcoin is no longer an isolated asset. It's embedded inside the Wall Street machine, inside portfolios, inside margin systems, inside option structures, inside ETF flows. That means it inherits the same reflexivity, the same mechanical pressures, the same feedback loops. And here's the important part. The system that forces it down can also force it up. When positioning flips, when volatility compresses, when dealers are short gamma instead of long, the feedback loop reverses. Instead of selling into weakness, they must buy into strength. Instead of leverage contracting, it expands. Instead of dominoes falling downward, they fall upward. That's when you get vertical rallies. That's when price acceleration feeds on itself. Not because of hype, not because of tweets, but because structure demands it. So what did this crash really show us? It showed us that Bitcoin has matured. It's no longer just a speculative playground. It's integrated, institutionalized, systematized. And that means moves like this are not emotional events. They are mechanical events. Understanding structure beats reacting to headlines. The market didn't panic. The system rebalanced. If you found this breakdown valuable, subscribe for more structural analysis. And let me know in the comments, do you think Bitcoin being integrated into traditional finance makes it stronger or more fragile? I'll see you in the next one.